But first, stocks ending the day higher, closing out the best two-week period the market has seen since March. For more details, let's go to Deborah Costrin at the NYSE. Deborah?
Thanks a lot, Pim. Yes, a pretty rocky session in Friday's session, but for the week, we saw some pretty good gains. The Dow Jones Industrial Average up 3.99%. What we saw, the S&P also up 4.13%. And as Pim was saying, the best two-week rally since March. The Nasdaq up over 4%. And year to date, our numbers really kind of changing after last week, what we saw. The Dow Jones Industrial Average once again back up year to date, up 3.6%. The S&P up 8.4%. And the Nasdaq still, of course, it's been the winner all year, up almost 25%. This week, it was all about earnings. And so far, about 75% of companies have beat their second quarter forecast. But in Friday's session, what we saw, a lot of back and forth. One reason was comments from Fed Chairman Ben Bernanke. He said that the central bank is winding down emergency measures established in the financial crisis, and to many traders that meant that maybe the worst is over. Earnings also having a big impact in Friday's session. Technology stocks, they were the biggest weight on the market, kind of holding us back. That was after the market reacting to earnings from Microsoft, the company reporting a 29% profit decline and sales that were $1 billion short of analyst estimates. And also with Amazon, kind of same story there, falling the most since November after reporting a 10% decline in second quarter profit and revenue that was also less than analysts had expected. And as we're looking at the week as a whole, material stocks actually the biggest gainers in the S&P 500 for the week, also putting in a pretty impressive performance in Friday's session. Energy stocks, the second best performers this week, as crude oil rising on Friday to a 3-week high, also had its biggest gain since May. Crude oil closing out Friday's session $68.05 a barrel. Next week, we do get earnings from ConocoPhillips and also Hess. We also have other earnings to tell you about next week. Verizon, one notable earning on Monday, the head of the company's wireless unit telling investors on Friday that mobile phone customers probably won't recover from the economic slump until at least the fourth quarter. Other earnings next week, we also have WellPoint, Visa, Aetna, and Quest. That's it from here. Pim, now back to you in the studio.
Thank you very much, Deborah Costrin, reporting from the NYSE. Now, stocks rise, but my next guest says that things could get stuck here for a while. So what do you do? Well, let's bring in Joe Keating. He is the Chief Investment Officer at RBC. He says pay attention to the world of dividend-paying stocks. Joe Keating, good to have you with us. Thanks for coming in.
Hi, Pim.
Okay, we lived through a very nice rally this week in stocks. Is this really the result of what went on with earnings, or is there something fundamental happening in the economy?
Oh, I think it's a result of earnings. You know, we had a tremendous rally, as everyone knows, off of the March 9 low. And that was a relief rally, that the financial system was going to fall apart, that the economy was even going to be in a deeper recession than it fell into. And so we've come out of that. Now we need to move into the next phase. And the next phase is really going to be dependent upon forward-looking earnings in the economy. So we need to see the economy complete the transition from recession to recovery, which we think is actually happening. We started writing about this back in March, that it was beginning to bottom. We think the bottom is probably here. So we need to see the economy begin to recover. We think it's going to be a slow recovery. And with that recovery, we need to see some growth in earnings. And with that growth in earnings, then we can see some higher stock prices.
Okay, but when you talk about earnings, I mean, don't we then have to bring in what analysts are calling for in terms of those earnings estimates? Because it seems as though the bar was set pretty low.
Absolutely was set low, Pim. And I think that's one of the reasons why we've had the rally over the last 2 weeks, as the second quarter earnings easily beat those estimates of what was in the second quarter. But now, sort of fundamentally, if you want to be moving into the market at this point, we need to see earnings begin to truly grow. We need that top-line growth, because a lot of the earnings that were achieved in the second quarter were because of cost-cutting. Which
right. I mean,
it
started off with IBM, for example,
Absolutely.
right? I mean, they beat all of the estimates on EPS, but it was on falling sales.
Right. Now, the good news is that the companies across America are very leveraged to profitability if we get some revenue growth, because of the decline in expenses the work that they've done. So we're positive on the market. I just think, to me, if I'm wrong, the market's going to do better than I expect. I've kind of taken off the table the fact that it's going to do worse than I expect.
Okay. So in the meantime, then, you want to wait and get some maybe confirmation looking at third quarter earnings. You want to hear what's going on with guidance from a lot of the companies. In the meantime, you say investors ought to be paying attention to what? Dividend-paying stocks, right?
That's right.
Get paid while you wait. Is that the theme?
That's exactly right. Well, in a slow-growth economy, Pim, why not get paid to wait, to wait for the better economy, the better earnings, and therefore the better stock prices? So we like really big brand-name companies. We've talked about it before. And there are some really good dividend yields available because while stocks have rallied off of the March 9 low, they are still fairly, they're down, say, 25, 30%, 40% from the October of 2007 highs. And if earnings do anything, that means we've got some good dividend yields.
All right, so let's talk about some of the industry groups, right? You like,
sure.
There's some consumer staples. I know you want to mention what, Colgate, Palmolive.
I like the big brand name companies, Pim. We like Colgate, Palmolive. We like Pepsi, and we like Procter and Gamble. Typically you buy these stocks historically with dividend yields of about 1.5% to 2%. Today, the dividend yields on them are about 2.5% to 3.5%. So it's a great time to go into these companies, put them away, and let those dividends grow over time as you move into retirement.
Okay, and what about some of those master limited partnerships, the energy stocks? Is that also the place to go right now?
We really like the master limited partnerships. This is the energy infrastructure. It's the pipeline companies. All the energy that we use, be it natural gas or gas fuel for our automobiles or for airplanes, it flows through the pipelines. They're not that sensitive to the price of the commodity. At least we stay away from those that are sensitive to the price of the commodity. It's more like a toll road. So you're going to get paid as the either crude product or the refined product flows through the pipeline. Distribution yields of around 7 to 8%. I think that's hard to beat.
All right, so you like that annuity stream in more ways than one.